Hi, tax attorney John Hyre here, and going through a few more questions just for frame of reference. I used to have something called the inner circle. We used to take questions and do a good deal more besides. So I thought I'd give you a sample. We're restarting it, and so we're taking a bunch of questions and posting them. So we'll get started. I have a tutoring business that generates 300 to 500 net annual profit. Nice. I contract with large school districts, and the revenue is almost guaranteed each year. My largest district, which accounts for 75% of my revenue, just renewed my contract for another 4 years, and I expect my revenue to grow 50 to 100% over that period. I'm looking for my exit strategy, and I think this might be a good time to sell since I'm beginning a new contract period. I have 2 employees. So sell now. I think if you sell now, you're just selling whatever you've got. There'll be no tax planning, there'll be no tax gains, and maybe that's okay. You still have the decision to make of what are you selling? Would somebody buy the company? Would they buy the assets of the company? I actually did a presentation for the better part of a day at Advanced Strategies in Dallas a few months ago, and we covered just a panoply of options of when you're disposing of a business, disposing of rentals, whether it's a sale of an asset, sale of a company, what are different methods to save yourself money. So we spent a lot of time going into detail, and that information will find its way into the inner circle as one of the many topics that appear there. So we're going to do a bit of a synopsis of that because I don't really want to spend 4 hours on it. Should you sell now or in 4 years? I mean, it looks like you're going to grow the revenue. So the more you grow the revenue, the larger the multiple. There is something to be said for, but a buyer wants to see guaranteed income. First thing I'd look at is the contract, by the way. Does the contract you have with the school districts allow for assignment, sale, etc., or does it rely on you personally being present? My gut feel here is I would probably wait at least 2 years, maybe a smidge more. It lets us do some tax planning. Now we'll see what the different options are because some of them go over more than 2 years. So you increase the income, which increases the multiple on sale. You do some tax planning, some of which requires a certain amount of time. Your income and your multiple goes up. I'd probably wait. And frankly, depending on how things look, if you think there's a likelihood of renewal in 4 years, then I might just wait until it resets or right before it resets. But my gut feel is at least 2 years. I don't know the numbers the way you do, however. What tax strategy should I initiate now and save on taxes from the sale? It depends. There's always a trade-off. Anytime we do tax planning, there's always strings attached. And the question becomes, which strings are acceptable to you? A few thoughts. We know I love rollover business startups. ROBs basically have your solo 401k own the business. It's a bit harder because you have employees. It's not impossible. It's easy to move deals that stand on their own separately into a rollover business startup. For example, renewing the contract inside of a rollover business startup would make a lot more sense, be more defensible, be a lot easier because the contract relies mostly on you. And since it relies on you, you can sell your services from pretty much anywhere you want. For example, I take clients, some in an S Corp because I want the income directly to me immediately, and some in a rollover business startup. I want that income to end up in my solo 401k. And to be clear, my Roth 401k. It doesn't have to be a solo. Since you have employees, you would have a safe harbor plan. And there are people who do really good safe harbor plans. If anybody wants a referral, I have one source in particular. The problem is he has bandwidth issues, so I'm careful how much I send to him at once, but he is very much the absolute best. So one thought here is we try and figure out, can we get to a ROBS conversion? It'd be easier to wait the 4 years. There might be a way to do it in the interim, in which case it's going to depend on the valuation of the business and how much is the business dependent on you versus is its own system and the employees. Now, the fact that you could sell the business separate from you means it probably does have a value separate from you. That makes getting it into a rollover business startup considerably harder. You might do the sale to a children's trust. You sell to a children's trust. It's an irrevocable trust. For example, you sell the business on a 30-year interest-only note. That defers your tax hit for 30 years. You live on the interest in the interim. The asset goes into the trust, sits there for 2 years, then sells. Now, it may sell for more than what you sold it to. It sounds like in this case it would, because you're increasing the value of the business over time. So a large portion, when the trust itself sells the business, a large portion would not be taxed because you're selling it at present fair market value. But if it appreciates beyond today's value, there will be some tax inside the trust, and it could be significant. So you have to balance these out. But it would cause deferral of an awful lot of the tax. You would get the interest income on the note. Now, what's the downside? You don't own it anymore. The trust does. It takes it out of your estate, which is good for estate gift tax purposes, but you may not have children that you want to give things to, or any at all. Also, there's a 2-year waiting period. If you're going to use this technique, you want to move on it soon. You really want to have the business sold to the trust 2 years in advance, and you don't want any sale on the horizon. If you start negotiating a sale and just have the idea that you're going to wait for 2 years to do the sale, there are problems with that. So you want to sell to the children's trust. It's going to defer a lot of the gain, but not all of it. If there's continued appreciation, it gets it out of your estate. You get a note which pays interest for 30 years, which you presumably can live on. Growth occurs inside the trust. It is, depending on what kind of growth, maybe taxable for income tax purposes, maybe not. Most people structure it for not, and it has estate planning benefits. But the downside is you no longer own the asset, you no longer own the business, and so you have to take that into account. Something you might do now, especially if you're going to wait out the 4 years, is set up a defined benefit plan. So a defined benefit cash balance plan allows you to make very large contributions to the plan. It's a traditional plan. You would make very large, depending on your age. Most of my viewers are going to be in their late 30s to early 60s, and they tend to hover in the late 40s and in the 50s. If you're of that age and you make contributions to a defined benefit plan from the company, so it's contributing directly to your retirement plan, those contributions can be very large indeed, and we have referrals for those as well. Now, the issue becomes, how much do your employees make and how old are they? A good answer would be they're young and they don't make much, in which case the cost of setting up the defined benefit plan is not really high. On the other hand, if they're well paid and they're older, then you have to contribute to their plans as well, and that can become very expensive. So there are trade-offs as always. What happens when the cash balance plan ends? Let's say you sell the company, they decide not to continue the pension plan, which is likely. You would roll it over into a traditional 401k and presumably start converting that traditional 401k to Roth in a timed, advantageous manner. Something you want to do no matter what, you almost certainly want to be the one who owns the company goodwill. If you sell the company in a more standard fashion, or if you sell the assets of the company, let's say a buyer is not interested in the company, which is frequent, they're only interested in the assets of the company, you want to define those assets. The first thing you want to make sure of is that you own the goodwill of the company. The goodwill is a long-term capital gains asset. So when you sell, you pay long-term capital gains rates. That's more favorable to you than selling, say, equipment or other ordinary income tax items. Now, this kind of business probably doesn't have a lot of equipment. What happens, you have to be careful if the goodwill is considered owned by the company. That can have negative ramifications, more so if you're dealing with a C Corp, less so if you're dealing with an S Corporation. By the way, the default is you own the goodwill. What do you have to do for the S Corporation to own the goodwill? You would have to have an employment agreement with the S Corporation, and that would have to include a non-compete agreement. Most people don't do that unless someone tells them to. So the default setting, if you don't do those two things, is that you own the goodwill. It's a long-term capital asset. If you sell the assets of the business instead of the business itself, it helps preserve or enhance long-term capital gains. Be careful. I have seen some cases where someone's CPA right before a sale tells them, oh, you need to have an employment agreement with the company and you need to have a non-compete agreement before you sell. That puts the goodwill in the company. That can have adverse tax consequences, especially with a C Corp, maybe in some cases with an S Corporation. Remember, you need to know the contract restrictions. All of these things I'm suggesting, if the contract you have with the school district directly or indirectly keeps you from making these moves, assigning things, transferring ownership, etc., that's going to be a problem. So you really want to check that out. A lot of people are going to suggest Code Section 1202, qualified small business stock. If you have qualified small business stock, you've held the business for a long enough time, you would have to convert it to a C corporation. Then the sale could potentially be tax-free, at least on the first 15 million. So that's really nice. That could work. The problem becomes you're not allowed to have Section 1202 stock if the principal asset of the business is the skill or reputation of 1 to 5 people. Well, there are only 3 of you in the company. Probably the district knows you. I'm not sure if they would sign up again if it were not you, if it were someone else. So the question becomes, could this possibly be a valid service that 1202 covers and you get the tax-free treatment? Or might it be not a valid service because the principal asset of the company is the skill or reputation of 5 or fewer people? That's very subjective. Also, 1202 only works if there's an asset sale. 1202, sorry, wrong, other way. 1202 only works if that's how you know it's not AI. I stumble like a human. 1202 only works if you have a stock sale. So you really have to sit and think about who would buy this, would they buy the stock versus buying the assets. If it's going to be an asset sale, or they would buy the stock, but there would be a massive, massive discount, which does happen sometimes, for their buying the stock because they want the assets, not the company. If there's that sort of problem, then 1202 is not going to work. So there's some ideas of how this business could reduce the income tax on sale, the capital gains tax on sale. All of them have strings attached. All of them require detailed review, but it's a good starting point. Would you sell and keep equity in the company to take advantage of any future gains? It depends on the numbers, right? First of all, the buyer may require it. That's pretty frequent that the buyer wants you to stay involved either through equity or a salary or consulting agreement. So it depends on the buyers. And again, you have to find out who are the likely buyers and what do they tend to require. And then you can start discussing what form shall that take. Should it be that you're a partner? If so, for how long? Now, usually when you're required to stay on as an equity holder, you're able to defer gain to that extent. So let's say they buy out half, you pay gain on that half, and the other half is deferred because you remain a partner to that extent. Usually under Code Section 721 or 351, depending on if we're dealing with corporations or regular LLCs, you can defer gain on partnership interests you get from a sale. So it has to be structured ahead of time. It has to be thought about ahead of time if they're going to require equity. You might want to consider receiving consulting income into a rollover business startup. And the rollover business startup could be just you. It could exclude your employees. You have to time it very carefully. You should talk to someone before the sale. A lot of the time when someone buys the company, they like to classify some of the sale as consulting fees, and they pay you to be available. And they like that because they get an instant write-off. Now, normally, sellers don't like that because instead of long-term capital gains treatment, they're paying full ordinary income tax rates and they're paying self-employment or Social Security tax on the consulting income. So sellers tend not to like it. But if you set up a rollover business startup and you run your consulting only in the future, not now, but in the future, right before you sell, right during you sell, right after you sell, depends, that's split second in time. You run some of the sales price as consulting fees. Think about it. The C corporation that is part of the rollover business startup pays 21% tax, and it pays it once. You then distribute that money from the C corporation, usually 98% to the Roth 401k, 2% to you personally. What does that mean? There will not be any further income tax on that money. It gets taxed once at the federal rate of 21% plus whatever your state rate is. 98% ends up in a Roth 401k, 2% ends up in your hands. That actually is desirable and would make the buyer happy because they want more of the sale to be classified as consulting fees. Now, don't get silly. It's funny, I was just working on a deal right now, and it has to do with somebody buying a business, my client, but we are dealing with the seller and the seller's tax consultant. What's the problem in this particular deal? It's a large one. We are structuring it mostly as a rollover business startup, and it's a very large deal. The net present value is well into the 8 figures for structuring it that way. The sellers tax consultant. Why do I put it in quotes? If you notice online, there's a proliferation of tax consultants suddenly selling you business, and it's really cheap. I'm going to save you a lot of money, and it's only $5,000. That's because you're dealing with AI. And I've seen what comes out of AI, and when it's not filtered through a knowledgeable human, it's garbage. And that happened in this particular deal. The seller said, well, we're going to help you out. We're going to structure this as, here's the full purchase price of the company, which was in the high seven figures was the purchase price of the company. We're going to structure it as 90% consulting fees and 10% sale of the company to help you. So the intent was good, but the execution beyond incompetent. Think this through. The company's worth what the company's worth. They already agreed to what the company's worth and to have a purchase and sale. And all of a sudden they're going to say, just kidding. The company's only worth 10% of what we said, and the rest of it is for consulting. That is fake. That is fake and would get you penalized. If the IRS looked at that, that would never, ever hold up. It's too much consulting fees. It's ridiculous. In fact, it's so fake, it might be borderline fraud or maybe past the border because it's just so out of whack that the IRS could come after this in very, very ugly ways. So the consulting fee idea is worthwhile as long as what? The number that you attach to the sale of the company, the number you attach to consulting fees, each one of those numbers is reasonable. So there are some ideas for you. I'd be curious to see what you come up with. Let me know.